It's our great pleasure to welcome back to the Market Huddle Plus, Warren Pies. He is the co-founder and strategist of 314 Research. Warren, thanks for coming back.
Hey, thanks for having me back.
You've had some great calls recently. I remember you came on our podcast. You were bullish oil. You were actually also bullish stocks. And I guess let's just start there with the stocks. We had a little bit of a correction, let's say, like it was 5% correction. I saw from one of your pieces the other day that you said, to reiterate, the historic message is simple: buy 5% dips, but sell 10% corrections. I kind of thought we might have a 10% corrections, but we didn't. Do you think one's still in store?
Yeah, I think it's always hard to call for a 10% correction just randomly, but our message to clients, we've had two back-to-back double-digit gain quarters, Q4 of 2023, Q1 of 2024 for the S&P 500. And so I think it makes sense to consolidate. And I do think that the overarching narrative that drove those gains is starting to change, the soft landing, Fed pivot narrative. And so in my view, the odds of a 10% correction are greater right now in this quarter than they have been in a long time. And so we go back, and I think 2012 is a good comparison. We've been tracking that analog closely. In 2012, you came off of two back-to-back 10% quarters. So one of only three cases where that's ever happened, Q4, Q1, and then into Q2. It was also a presidential election year. And so, I think there are some interesting dynamics at work, especially when there's an incumbent presidential election year, which that was. And so it's hard to get too bearish on the market during those times. But when you look at that and the way the market handled that Q2 period with the Eurozone crisis and the dollar strengthening and the Fed having to step in, all that stuff, I think that it's dangerous to get wedded to one example exactly, but I see something like that in store for the markets in Q2. At the very least, it's a good time to increase your cash position.
The other day, you actually quoted Jim Chanos about how this market looked a little bit like the 2000 market. One of the things that you highlighted that I think is just fascinating is you say factor leadership resembles market tops, including the 2000 peak. And you talk about the momentum factor and the market cap factor. Could you explain what those are and why you watch them so closely and what you think that looks like those previous periods that were actually quite scary for the market?
Yes, so factors, the way we were studying factors in that particular case study, we would break the market into top and bottom quintiles. So top 20% and bottom 20% by a given metric. And, there's all kinds of fundamental factors and price-based factors, and in this case, we're looking at two very simple ones: momentum, which is basically your 12-month rate of change in
Right.
selecting the top 20% versus the bottom 20%, engaging how that factor is doing. And then market cap. So you're looking at the top 20% largest stocks versus the smallest 20% in the S&P 500. The universe here is the S&P 500. And it's very rare to see both momentum and market cap intersect so much. And that was back in March, which when we look back might end up being close to the peak in the market. And that was, we were seeing a strange intersection of market cap and momentum. Last time we really seen that, we saw that coming off of around the COVID crisis. And we also saw that during the end days of the big tech 1999-2000 bubble period. And so kind of similar backdrop, market structure.
You actually said the same. It was 2007 that this happened 4 times. You highlighted 98, 2000, 2007, and 2020.
Yeah, they're all pretty scary cases. They're pretty scary cases. I try not to be alarmist, and I don't want to be known as someone who's just peddling fear. But I mean, that's the stats. I mean, I think that is a market structure that's worrisome when the biggest stocks are also going up the most, and all of these things are that's what's driving the index level gains. It creates an structurally kind of unstable market backdrop. And so you really want to see a broadening rally. And the market's kind of weakened in the say month and a half since then. So I don't expect us to go into some kind of major bear market like those cases, but if we don't broaden out, that's a real problem for the market. At the very least, it's hard to get very bullish going forward.
I'm going to ask you a little bit of a technical question here about factors, because I think a lot of people hear that and they think it sounds kind of fancier than it is. And one of the things that you just highlighted is how you say you just take the top 20% of the best performing stocks versus the top bottom 20%, and you look at the difference in the returns. I always find it interesting that people won't document what period they're rebalancing their factors, because I think it could matter a lot. Like Liz Ann Saunders highlighted from Schwab, she had this great point where she said, depending on when you rebalance your momentum factor, you could have had very different looking baskets. Are you frustrated with that? And do you do that? Do you do it yourself? And how often do you rebalance the momentum factor, for example?
Yeah, we do it ourselves, and I'm gonna have to go back really quickly and look at it, because I think we say it in the charts. I believe we rebalance monthly. We like to rebalance things on a more frequent time frame. We run so our stock selection, and it does frustrate me, because when you start building your own factors, which we do build our own factors, I think that's the only way to do it. You kind of want to look at the data. There's a lot of stuff that gets hidden within, like you're saying. You could do top decile, bottom decile. You could do top half of the market, bottom half of the market. So there's a lot of massaging of the data to you do these studies. And there's so many different little levers you could pull when you're creating these studies. So yeah, we usually will do like a monthly rebalance. We do that for most of our strategies. So we have more turnover in our strategies in general. But it's also important to match your benchmark. So like when we do, this gets a little far afield, but it's very similar. It's like when we have an asset allocation model, it rebalances monthly. We benchmark it to 60-40 rebalanced monthly. We also have a quarterly asset allocation model, rebalances quarterly, and we benchmark it to our quarterly 60-40.
Okay.
And so sometimes when every month we do the monthly update of the performance. How is our model performing? We show it to clients and everything. And then we also do quarterly for the quarterly model. And what you see is the benchmarks will change. Like, so you get client questions like, well, why is 60-40 higher in this one version and lower than this other? And it's all down to the rebalancing. So it matters, those little details matter, how the study comes out. Also, equal weight versus cap weight, which you're doing factors, you're equal weighting, but all that stuff matters.
Right. So you talk a lot to a lot of quant shops. I'm wondering, like, how often are they rebalancing? Like, what is, like, obviously that's a huge generalization, but is this like daily? And then the other question I have is, do you notice individual performance of equities as they come in and out of those models, like a highly followed factor model, something drops out of that, it actually performed poorly at the kind of the start of a new month? Have you ever looked at that or thought about that?
Do I see that? Yeah. I would say somewhat. So what I'm most familiar with is our stock selection system. And we do have, so we call it our full cycle trend system. It's I'd say it's our best model. And we have a lot of clients following it and putting real money to work behind it. It's beaten the market, I think, 4 out of the last 5 calendar years. It's destroying the market this year. And it's a quality factor. We create our own quality factor, which is proprietary. And then we have a trend overlay. So we're intersecting trend with quality. That's the basis of this system. What I like about this system, I haven't answered your question, but what I like about the system is that it's creating, because we're using the quality factor first to narrow down our overall membership set. And then we select the top 20 stocks based on trend every month. And that's how we're doing it. And we have a little mean reversion flag in there. So we're often buying dips in that every month because we like the quality universe we're in. We look for a decent intermediate term trend and then a dip. And that's kind of there's a lot more that goes into it, but that's the crux of it. And you see a lot of the beginning of the month when we buy those new stocks, I get a lot of clients being like, that's magic. How does it work like that? So I don't know about every strategy, but ours, I definitely, when you're paying close attention, I do notice there's something that happens towards that month turnover for some of these stocks, which I've noticed.
Because it just, as more and more people do this sort of quantitative trading, and we all know the pod shops are dominating and winning $8 out of every $10 of new hedge fund money, that it's got to be increasing. And so these funds have to be kind of influencing the markets more and more.
Yeah, I think so. It's like your original question is like, what time frame do you operate on? You see it more and more around options expirations. You're seeing it on month end, quarter end, when all these things align. You start getting just bouts of volatility. I don't think that I'm imagining it. I think that that's
Right.
becoming a structural component of the market, and then you'll probably have players enter the market and try and take advantage of it, and then it goes away.
Okay, so staying on the stock market, I'm going through your notes here and looking through your research report. And one of the things I realize is that you do a fair amount of work on the equity risk premium, meaning the kind of earnings yield versus the T bond or the Treasury yield or whatever yield you want. First of all, do you think that that's still a great indicator because it hasn't worked recently? And what do you think it's saying for the going forward?
I think that well, the thing that's happened is, so valuations have kept you out of the market. So we've had to kind of discount valuations um, for this cycle. And our basic rule of thumb is, if our economic model doesn't see a recession, then we have to be really selective for when we want to be less than market weight equities, which we are. As of just recently, we did move to underweight equities, but hopefully it's tactical. And I
Okay,
don't
wait,
see.
wait. Can I just interrupt there and just to understand this? So you say if I don't see a recession coming from an economic point of view, I won't be as like I'll pay up for stocks, even though I might think they're overvalued because they potentially could get even more overvalued.
That's like a rule of thumb that I
Okay,
operate with.
that's
Yes.
actually really smart, and it's stuff. But so it ends up being the economic decision about whether or not the chances of a recession are what's driving it.
Yes, and of course, like, rules are meant to be broken, so we are
Right.
underweight, slightly, very slightly underweight stocks right now for this Q2 period. But I say that rule to keep myself honest, because if you don't see the ingredients for a recession, I feel pretty confident about our recession framework, and we don't see a recession right now. We don't have the evidence to make that case. History says that we've already had a one non-recessionary bear market. They're usually on the shallow side. To get another non-recession bear market we had one in 2022. To get another one this close together would basically be unprecedented in the stock market. And so you got to keep that in the front of your mind. It's like, even though we have valuations are horrible as a timing tool. And so, you just want to stay on the broad right side of the trend. You might not love the valuation of the markets, but you have to acknowledge that the general course of affairs is for stock prices to go higher if you're not going to have an economic contraction. And so
All right.
that's just a built-in rule of thumb.
So I think that's awesome. Actually, I've never thought about it that way. I think that's the genius thinking. Why do you feel so confident that we aren't going to have a recession? You said that there's nothing really on the horizon. What would it take to get you more worried about a potential recession?
Yeah, I think, number one, like, let's think big picture. It's difficult to have an economic contraction when you're running deficits the size that we are right now. And the fiscal stimulus is just so powerful. And if you had to pick one thing that's defined this cycle, it's been an underestimation of the power of fiscal spending across this entire cycle. I'm guilty of it. Everyone, in my view, has been guilty of it and continues. There's still this kind of slow moving realization of what's going on with the economy. And so that's your structural component. But our framework goes to specifically goes to residential construction payrolls in the housing market. So our theory, and when you go back and study history, is you basically don't get a recession unless there's call it 8%, at least an 8% drawdown in residential construction payrolls. So if you see housing construction jobs start to roll over, that's where Fed policy shows up. That's where the economy first starts to roll over. So we build up a model based off of basically the housing market, and it tells us what to expect, what the necessary amount of construction jobs are, and where that's going based on the backlog of projects, multifamily, single family projects. And that's kind of we look at a bunch of stuff. I'd say we look at everything, but like, you have to have a source of truth. Just like when we downgraded equities and we moved off this soft landing thing, our source of truth was housing inflation. We look a lot at housing. And so, to me, from the economy side, we're continuing to see single family starts pick up and respond really to these lower rates that we saw coming at the end of last year. And so At this moment, I just can't. There's no evidence. We model it out. Even it might be in a muddle through kind of economy for a lot of reasons. I just can't make a case for a
So
recession.
what you would see layoffs in the housing sector, would be the precondition that would get you nervous about a potential recession?
Yep. If you go back almost every modern recession, you have a 8 to 10% drawdown in residential construction payrolls. So that's like our source of truth and what we're looking for to make a call on a recession. And so right now, housing jobs are basically making new cycle highs. So it's totally going the opposite direction from what you would expect if you're going into a recession.
I think that's fascinating. I'm wondering if as the market gets quicker and quicker and smarter, whether it'll actually be even anticipating a like anticipating a recession, even if you just get a slight downtick in that, right? In that indicator.
Yeah. So that is an interest. Like I usually don't get into the weeds on it, but like one of the factors is like we're talking about revised data. So if you go back and look at history, you're dealing with revised data. And when you go to these subsectors of the economy, like residential construction, you only have so much history on unrevised data that you want to look at. So there's a little bit of art that goes into our call on the recession side.
Why don't you explain to people about that? Because I think a lot of people don't understand it. And even I see a lot of charts on Bloomberg, people post up and they're like, oh, it was so obvious that this was already occurring at this point when they talk about 2008. And I'll say, no, but you're going on the revised data of jobs. And the reality is that that's not where the initial prints were coming in at. So explain to people what that is.
Yeah, they're especially in payrolls data, it's constantly being revised. It's once you start getting into it, you realize they're actually still revising 2008 data today.
Come on, really?
Yeah, you go back into it. Those theories are shifting every month, and it's really frustrating. So you have to really know what you're looking at.
Oh, I didn't know that. I kind of assumed that, like, I knew that there's a first run. Then there's the revision that you see, like, so when we get, for example, the payroll number on Friday, we're going to get this number for this month, and then they're going to revise last number. And then I thought there was just one more revision after that. You're saying that they could be revising it even.
They still revise it even way years into the future. I see it in the data when we move it. Maybe there's something. Because I'm not a classically trained economist. We just play with the data. So what I see is the data moves. You'll still see the data moving all the way back into like the aughts. And if you think about it, if they revise a year ago, then that impacts what happened the month before. And there's like a little ripple effect that goes down the labor economy and through the data. So, I mean, that's kind of just that doesn't change a lot after the first few revisions, like you're saying, but it's important to track where the data is trending, where the revisions are coming in. And also to always play with real-time data if you're able to, because otherwise, like I said, you can see these really clean 8 to 10% drawdowns in residential construction payrolls before these recessions. And in real time, it may have been like a 3 or 4% drawdown is okay. Fine. And so in real time, when everything's said and done and you get through a series of revisions, I think our rule of thumb will hold. But in the real time, when the bullets are flying and we're getting like the jobs reports and stuff on Fridays, that's when you'll you want to make sure that if you're seeing the direction move. Like that's why I go back and say we're making new cycle highs. If we were like in a 2 or 3% drawdown, which I think we were in real time during the summer last year when rates were peaking and stuff. And we were nervous about a mid 2024 recession because of that.
Right.
But that turned around and right now, we're at new highs, but it's important to keep in mind. So I didn't want to open up a whole can of worms there, but
no, it's interesting stuff. I love that you're a data geek like me. All right, let's talk about, before we get off this, equity risk premium. Does it have any value?
Not really. I think that, not for timing the stock market. I mean, it gives you some general idea of, where if there's a lot of an air pocket underneath the market, or you can kind of back out a growth rate. But I look at it more from competition with with risk-free rates and what's happening in the bond market. And I've
Right.
seen that really that's been our the biggest change in the markets is structurally that stocks and bonds are starting to move together, or yields and bonds are starting to move together. And so to me, that's the biggest, that's been the biggest change we've seen. That's why I think when you talk about the old rule of thumb, you brought up of buying a 5% dip, used to work better because you end up with you get a 5% dip in the stock market, you end up getting a flight to safety bid into bonds and yields go down. The new pattern is for bonds to sell off first and then stocks to follow as the pressure from those yields hits the stock market. And since 2022, you don't really want to buy a 5% dip. In fact, the rules are changing. The dips are becoming more violent because there's no cushion from the bond market. So you're getting, routinely more 8 and 10% pullbacks than versus 5%. So that's why we brought up that whole playbook and what's going on there.
I tend to agree with you. I've been saying this for a while, that bonds used to be the ballast to your portfolio. It's going to end up being the anchor that drags your portfolio down. Since we're talking about bonds, and I actually think that I suspect you also feel that bonds are a risk to the stock market, and that's part of the reason that maybe you become less constructive about the stock market. Let's talk a little bit about the Treasury. In one of your reports yesterday, you said the Treasury itself acknowledged that demand was falling and the term premium is heading higher. To quote from the report, Secretary Yellen said, demand for U.S. Treasuries may have softened amongst several traditional buyers. Bank security portfolio assets have been declining, blah, 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 blah. The appreciation of the dollar, blah, blah, blah. But this is the part that I thought was just fascinating. You said, consistent with the idea that structural demand for duration risk hasn't decreased, investors may now require an additional yield or term premium to hold longer term debt. Finally, members also highlighted that the less negative correlation we have seen recently between treasuries and risk assets. So the Fed has recognized that the negative correlation between stocks and bonds is actually disappearing. Not the Fed. Actually, that's the Treasury. I'm sorry.
Yeah, I think that's from the T-back commentary. And I don't know when this podcast is going to come out, but tomorrow
tomorrow, so it'll be right in front of the QRA.
Beautiful. So we'll see what the TBAC, the Treasury Borrowing Advisory Committee, says tomorrow in their commentary. They always put a commentary out to the Treasury. And I believe that's what I was quoting there.
Yes, you were. Yes,
maybe back in November, and it'll be interesting to see what they say. But that was really interesting because it was a point we've made now for years, which is that if you look at, we were making this point back in 2021 when QE was still going on, and we were looking at what was going on with term premiums. Why had term premiums structurally gone negative, and why were we basically getting a term discount is what we were calling it. Right. What was the reason? Why would there be a reason for the term premium to be negative? And I think that the best explanation, which it was validated there by the TBAC, is that bonds were during those years increasingly looked at as a hedge to your equity portfolio. And so, long-term treasuries acted as a hedge, and that is obviously going away. As you said, it's becoming an anchor versus a ballast. And to me, that was interesting to hear the TBAC acknowledge that. And then that impacts when they think term premiums are going to rise, it impacts how much coupon issuance, longer term notes, bonds that they're willing to float. And that's been, of course, like a big issue out in the market, and the amount of supply coming and all of that stuff. And so they're acknowledging it. They're looking at it. And whenever the term premium rises, they seem to get a little nervous in their commentary about how much supply they issue. And then when the term premium contracts, they seem to go back out into the market and issue a bigger chunk of supply on the coupon side. So it's very interesting dynamic. It's a really interesting time for a macro kind of investor.
The one thing that's kind of fascinating to me, though, is although they're nervous about the term premium, let's face it, it's still pretty low in the grand scheme of things, given the monster amount of debt and the monster deficits that we're running. And like the term premium's low, like let's call it zero. And not only that, the yield curve's inverted. Who knows, like in terms of where that should be. The bond market is still exceptionally well behaved, in my opinion.
Yeah, I think that's where that's you're getting to the nervousness of what's really behind our concern here in Q2 and what's going on is like I think the market and we thought there would be a quote unquote soft landing. I think that I hate putting that classification on things because the game doesn't end when the Fed cuts rates and does this mid-cycle adjustment. You go to another hand ultimately, and there probably would be a reacceleration of inflation. But we thought there would be a nice pocket in the data based on shelter inflation that would allow the Fed to cut somewhere in the summer here. And the market's realizing that's not going to happen. I think the market's realizing a number of things all at once. Some of the stuff we've talked about for a while. One of the factors that's in there is that the terminal rate or the neutral rate or whatever you want to call it, where the Fed can ultimately end this hiking cycle or this cutting cycle that's coming up that everyone's anticipating. The market's getting this slow realization. It's slow, like you said, that that neutral rate is higher and the terminal rate is higher. So you saw that in the Fed's last SEP. They marked up their terminal rate, their long run dot from 2.5% to 2.6%. We've been looking for that every SEP. When's that going to happen? And there's a quote we pull out from Jerome Powell back in 2018 that I put at the top of all these reports. And it's like, definitely I forget exactly, but to paraphrase, it's that deficits impact the neutral rate. And that's his view.
I didn't know he said that. That's hilarious.
Yeah. And so like, we like to pull that out from 2018 when he was like, he doesn't really talk about it now. And,
he's quietly forgotten that he said that.
I mean, it was a little safer for him to talk about it back then. But to me, that's what's going on is like the bond market is behaving. It so far has been well behaved. There is a feedback loop. Like I think if yields were to spike to like 5% or 5.25% tomorrow, clearly the stock market would have a some kind of conniption fit. And it would be reflexive. It would be self-defeating, that whole process. It's been self-defeating on the upside. It would be self-defeating on the downside. That's kind of what's making these long-term forecasts. They're kind of a fool's errand in this market because in 2023, we said this is the year of reflexivity. I think it's still going on. It's just we're in these cycles where every time we see the light at the end of the tunnel for disinflation, or the market thinks it front runs it, and by front running it, it prevents it from happening. You see yields fall, that reinvigorates animal spirits, financial conditions loosen, stock market goes up, wealth effect kicks in, and you start the whole process over again. So I think that's where we're at. I think that it's going to take a long time before you have some serious problem in the United States government debt market. I don't think that's imminent or anything.
But I don't think I think that's one of the problems is that it doesn't need to be serious to cause a repricing of the stock market. Would you not agree?
Not at all. No, and I expect it. I think that we're going that way. We're underweight bonds. We've been underweight bonds all year. And now we're underweight bond stocks and commodities and max overweight cash. So we're just kind of waiting. We think those, and why do you want to run out and buy the 10-year here? Like going back to the neutral rate, the SEP says 3 Fed cuts this year. I think it's probably more like 0 or 1. I mean, looking out to December is almost impossible because we have so much space between here and there. Like we just said, everything's kind of reflexive. But going to September, I think it's unlikely that we get a cut between here and through September. And so if you think of that, we're good chance we exit 2024 with cash yielding 5.5 or 5.3%. Why do you want to run out and buy the Treasury, the 10-year T-note at 4.7 right now? It's what's like I said, there's no recession on the horizon, so there's no real recession optionality built into that 10-year. Historically, when you get to the end of a cut cycle, the 10-year trades at about 140 basis point premium to your normalized Fed funds rate. So the Fed thinks the terminal rate's 2.6, but if it's really going to be more like 3 or 3.5, you still you really aren't getting much in the way of value on your long-term debt here. So I don't think, again, I agree with you. I don't think that that you need to have a big something break, quote unquote. But I totally expect these longer-term Treasury yields to to rise, because you're going to have to. You're going to have term premium come back. You're going to have to put some value into that part of the curve.
And just to explain that last little bit, what Warren was saying was that if we believe that the R star, or the level that the Fed will eventually cut rates to on the way back down, is 3.5%, usually when you get to the last cut, the curve is really steep. So that means like a 210 would trade something like 150 basis points. You take 3.5, you add 150 basis points, you're still at 5.
Exactly.
Right.
Exactly.
And so if you're buying bonds today, like we could have actually, this is the part that I've been saying about bonds, you could actually have a cutting cycle and the bond market sells off.
I totally think that's like what people were saying to me when we were saying we expected coming into the year. We're like, okay, I think the Fed really wants to cut. That's operating in the background. I still think the Fed really wants to cut.
Oh, I agree. They want to, whether they'll be allowed to or
They
able to.
really want to cut. Yeah. You don't want to underestimate how badly they want to cut right now. For many reasons. So you got to remember that. And so the Fed really wants to cut. I mean, term premium's going up either way. They could cut, and term premium will mechanically rise if the yield curve uninverts. And I expected them to cut and then the 10-year yields to go up. That's kind of what I expected, just slightly. But yeah, well, I don't think we're even going to get to that point.
Okay,
so I think it's going to go up.
You know what? I could talk to you all day, Warren, but we're getting towards the end here, and I've got to finish up with a few things. First of all, crude. You're like my crude guru. You were bang on with your last call. I love the way you use the commitment of traders. You're not afraid to fade it. What are you thinking right now when it comes to crude?
Yeah, we were bullish coming into the year. I thought that there was a ceiling around $90 a barrel. And that's held right here recently. In my feeling, just like you said, we like to look at commitment of traders and fade it when it gets to extremes. And that's worked really well over the last, say, 2 years in the crude market. And we were coming off of this last bout of geopolitical tension. The hedge funds and CTAs were really closing out all their short positions. You're getting to that place where I thought we could fade it and maybe get short the crude oil market with some downside, and the positioning totally reversed in the last couple of weeks. And so it's not like we've built a bunch of short positions, but I'd call it middle of the road. So from here, I think that that puts the market on more solid ground. Our model, everyone always like our model's killed it. Model's better at calling crude oil than I am. And the model has gone back to bullish. It flips around a lot at the end of moves. And so it's that's just the nature of the beast. But I think we just are basically in a holding period here on oil. So I don't have a great big splashy call. But the downside that I saw coming into the year after, I thought we'd get to 90, and then I thought, honestly, OPEC oil would come back and that we had downside into the 60s, upper 50s later in the year. I don't see that anymore at this point in time.
Got it. Okay, and I'm going to put you on the spot. One last thing. We didn't talk about this, but the dollar. And I think you said highlighted how the Fed would like to cut. I think part of the reason they'd like to cut is they'd like the dollar to stop going up, especially against the yen. Do you have any view there?
Yeah, I think that's kind of the central player for why this Q2 correction would happen. If the Fed can't cut and all these other central banks are going to cut, and there's this, they all want to go at the same time, right? If the Fed can't, they're going to be the one holdout. The rates are higher here than other developed economy central banks already. And then if you see these foreign central banks start to cut, the dollar, when yields go up, because as the Fed can't cut, the dollar strengthens, and that's negative for stocks, it's negative for commodities, it's negative for earnings of the S&P 500. And so to me, that's kind of the lever for how you end up getting this correction. Then the correction could actually, we could tighten financial conditions, and maybe the data gives them a break sooner than people think. And that's kind of that push and pull that's going to have to happen in order for us to get through this cycle. It's not just going to be up and to the right indefinitely on the stock market and on risk assets. So yeah, I think the dollar is going to be strong here in the near term because of those dynamics that you're alluding to.
One final question. You talk to a lot of clients. Where do you think they're standing right now? Do you think most people are still long, like risk?
Yeah. I do. So like when we we upgraded stocks and basically we're pounding the table saying we think that this market's going to 5,200 before May. This was back in fourth quarter of last year. We thought by May we would hit 5,200 on the S&P 500. And there was a lot of clients who, not just clients, but just in general, I got a lot of pushback and disbelief. And I felt really uncomfortable with that position. And when we downgraded stocks, I've had a lot of questioning.
You're
here.
uncomfortable again.
Yeah, and I feel uncomfortable, which is probably a good sign, honestly. But I feel sort of uncomfortable. Like, I don't want to be labeled as a bear. I don't want to hang out here too long. I'm already planning, like, the report we're going to write this week is like, when do we get back in?
Right.
Those are the things you have to check that psychology as you're going through this process. And so I think most clients are long. And when I watch TV and just kind of go do media things, I think that's the general sentiment right now.
I completely agree with you. All right. For people who want to learn more about you and your firm, your great firm, 314 Research, where should they reach out?
You can go to our website, the number 3, spelled out 14, FOURTEEN, research.com. You could go to there and put in your information if you're, we really service institutional clients. So if you're an RIA, a hedge fund, a high net worth individual family office, reach out to us. We'll give you some sample research and talk to you and see if it's a good fit. You can also follow me on Twitter at Warren Pies or at 3F_research. That's the company's Twitter handle.
Well,
or X.
Thanks for coming on, Warren. It's great chatting with you again.
Thanks for having me, Kevin.